What are the three most important ratios that you should be looking for when evaluating a business? You may assume it's debt to equity ratio, but that's not the case. So let's look at them. The first and the most important of all ratios is ROCE, or return of capital employed. Return of capital employed is one of the crucial ratios that I look for when investing in a company. I generally prefer ROCE to be above 15 or 20%, and you will seldom find a company where I have invested in that has an ROCE of under 10. There are one or two exceptions that I have invested in my portfolio, in my open portfolio, and generally it has been invested with a viewpoint that the ROCE is improving on a consistent basis, or if ROCE is not improving, then I am out of it. And in some cases, I have very little exposure for the other ratios being very good on it, and ROCE will improve over a longer period of time. The second most important ratio that I look for is operating profit margin. So I prefer to invest in companies that have unique businesses. So once the businesses are unique, the company can demand much better operating profit margins because they can sell their product at much higher price than the cost of the product itself. So that's why I look for OPM as one of the critical factor to understand how good the market offers the pricing power for the business. It helps me to understand the competitive landscape of the business as well as the expertise of the business in a particular domain or a field. Once the OPMs are high, I generally prefer investing in it. And again, you will not see too many companies in my portfolio that has an OPM of under 10. And there are one or two exceptions again for the same reasons that the OPM is set to increase, or the management has a focus of increasing the OPM, or I see there is a very high growth in the current stage of the business, and so they may have to take a hit on the OPM, but once they start to optimize their business processes, the OPM will increase. So OPM is the second most important ratio that I look for when investing in a business. The third and the most important of all the ratios is 3, 5 and 10 years past growth, as well as what the growth I am expecting in the coming 10 years. So I am generally not a value investor. I prefer to invest in growth. What I mean is, so I don't look for companies that are available at a very cheap price to earning ratio. And I don't expect the price earnings ratio to expand. What I'm looking for is high growth companies that are available at a reasonable price, but they keep on growing. So once they keep on growing, their price to earnings, even if it comes down, or P multiple if it comes down, still I make a decent amount of CAGR returns. So once I'm looking for that, I am looking for companies that can do good amount of sales growth, but more importantly, at least 25 to 26% CAGR profit growth in the past 10 years, and I expect similar run rate to continue. It can be because of say good sales growth, it can be because of say the cash flows that they are generating, and then those cash flows are being used to have some organic or inorganic growth, and the profit keeps on compounding at 26% CAGR. So once I expect the profit to continue growing at 26%, the share price, even if it is at high P over a period of 10 years, even if the P halves or 1/4, I still make double digit CAGR return. So if you have to select three ratios, top three, it has to be ROC, OPM and sales and profit growth. But if I have to choose 4 or 5, then ROC, OPM, sales and profit growth, then free cash flows, and then debt to equity ratio. So these are the crucial ratios that I look for before analyzing any business into further details. What are your most important ratios that you look for when investing in a business? Share them in comments below.